my trade that I was actually looking at for the day, Aussie dollar and GU. And right when they actually hit that low, I wasn't in front of my laptop. So I did miss out, mostly because I had a lot of things to sort out today. So I'll actually just be trading Asian session today. Right. So hope from what we did yesterday, last night, everyone has some of the stuff that we need to cover or we need to compile and have emailed through to me. So I'll be waiting for that. And if you have and didn't actually get it for some reason, then I'll just let me know and then I'll check even spam folder, so to speak. Okay, but aside from that, today's session will be a follow-on from yesterday's session. I'll just be doing, won't really be looking at any charts today as well. I'll show you guys how to set up the script as well later on. But we're just going to be working with, like I said, it's more of a breakout session for the guys who are not finding that consistency in the trading and who want to achieve that. So this is for you today. So let's get started. Now, like I said earlier, first thing actually to do, don't worry about the charts, don't worry about money, don't worry about all those things that actually just sway your attention from the real aspects of the market, the real things that you need to be focusing on. So firstly, the mindset, right? The mindset, you really need to actually broaden your mindset because it is the most important integral part that will ensure that you have trading success, because a lot of people know how to trade. People can spot M's and W's all day long, right? Now, if your mindset is not in check with what you do see on the market, what you translate into an actual trading opportunity, then you won't really take it, or you might miss it, or you might get in too early. So a positive mindset or positive attitude towards your trading also is something very important for me. Like I sliced the cake. You remember I had a chart, and for me, I would attribute 60%, if not more, towards the psychological pattern, and then about 30% going through to the risk management side of things, and only 10% to the technical side of things. So some people might slice it different ways, but I do assure you that the more technical that you're trying to find, the more confused you're going to be, and the less time you're going to spend on the things that really do matter, which is having the proper tools, putting them in place, and just following them in a positive sense, trying to get a consistent result. Because I do assure you, I know a lot of people who know a lot about technical analysis who still don't make money, right? I met a guy who was trading, I think, for 9, 10 years now. Probably it's been 10 years now. And the guy has dozens of YouTube videos. I think over 100 gigs of YouTube videos about trading. So he knows all of this stuff and they're still not making money. So it's basically focusing on the things that do not really matter, right? The technicals, yes, they do play a huge part. But at the end of the day, I mean, even with bad technicals, or just average technicals, if you have a superb mindset, positive mindset towards your trading, then you will do great things within your trading, so to speak. Okay, so the skill set also, we need to really deepen that. Skill set would be your ability also to be able to identify what you need to see from the market. Okay, and the tool set, which will be the tools that you're going to be using, mostly what you're going to get from MT4, like your indicators, all that stuff. You really need to sharpen your skills with that. But at the base, the foundation of it needs to be a positive mindset, because without that, then I do assure you that trading will become a very difficult experience for you. Okay, so now we did go over some of these, well, all of these yesterday. So this is basically a brief rundown of what I should be receiving sometime during the course of the week. Now, it's a proper trading plan. Now, trading plan, I did highlight some of the most important parts of a proper structured trading plan. I mean, a trading plan can get you out of indecisive situations. It can get you in very positive trades, and also at times you might take a trade and according to your plan it's still valid, you should keep it and hold it, and but you see, like, let's say you up 100 pips for instance, and your plan clearly defies or is clearly telling that no, you shouldn't exit the market as yet, and then you stick with the trend or you stick with your trading plan, and it does pay out. Okay, so I mean, with the experience I have, the trading plan is basically like a guideline. It gives you all the things that you need to know before you actually go into a trade. Right. So the forecast money management sheet. So that should be completed. As I did say, it's on a Telegram channel. Just hop in there, you get the forecast sheet, and you punch in your numbers there. So you basically have an idea of what kind of trading that you're going to be doing. So it's pointless saying that you're going to trade in every single day and try to make $100 each and every day, or $1,000, or $5,000. That is pointless because you need to see the bigger picture in order for that to be a goal that's going to be worthwhile. All right, so you need to have a proper trading schedule. Now, the proper trading schedule, as I said, is not because of, okay, now I need to specify which time I'm going to be trading and be so rigid with it. Obviously, if you're working, you work, let's say 8 to 5, you cannot trade during that time. People who try to trade on their phone, not very advisable. I wouldn't advise that. I'd rather you wait because your boss is calling you out there. He's telling you this, telling you that. You're trying to trade in between. Trading, as I said yesterday, it should be a business, not a hobby. So if you're trying to treat it as a hobby, like, okay, it's something that I'm just doing in between, it's going to be very expensive hobby to actually keep. Right, so fourth thing you need to have is a proper trading journal or a review book. I mean, it's pointless trading each and every day for an entire week and then just looking forward to the next week. You need to have a look back at what happened within the last week and eliminate one problem at least per day. So if that's all you do, because there's only a limited amount of problems or errors or things that traders fall into. So if you can eliminate one of those, let's say you focus on that one area. Let's say you're moving your stop losses, or you're hesitating, or that sort of thing. So you focus on that one problem, you rectify that, and then you move on to the next problem. So you never know which problems or things that you're facing with your trading unless you actually do a proper review of the trades that you do. Okay, so that does take time as well. It takes effort. For me, that's one part of trading that I do enjoy, actually doing a review on the trades that I have taken, because I mean, for me, it's not just a case of me trading my own funds, that sort of thing, but you can understand what I'm saying. So that basically translates to the fact that if you don't know where you're going wrong, you're obviously going to continue doing the same mistake. You're going to make the same errors each and every day. Right. So all research projects will be actually completed. I know Menzi sent out some stuff, and on the videos that I do have online that we uploaded online, there is a couple of stuff that you guys can listen to, and it's going to guide you through the process of doing those research projects, as they're called now. And tomorrow I'm going to show you guys how to do flashcards. That should be an interesting one, because obviously we can't completely neglect the idea that you still do need some practical, how can I put it, some practical ways for you to actually improve your technical analysis skills as well. Okay. Now, a lot of you guys may know that for me, this is what I believe in. Okay, this is Peter Lynch, very wealthy trader investor, and I mean, so this basically personifies, or it just is my trading. The simpler it is for me, the better I like it, because I know you can spend hours and hours trying to analyze charts, trying to figure things out, And the more you analyze, the more you're actually going to confuse yourself, because you might see a nice W formation there, you might see a nice M formation there at the top. And the more you actually analyze, you go on to every single time frame, you're going to really confuse yourself, and you're going to get confirmations on both ways, right? So for me, the simpler it is, the better I like it. You guys know how I denote a trend. Blue is above the white. For me, that's an uptrend. Blue is below the white. For me, that's a downtrend. Simple as that. So I don't confuse myself. And with my simpler way of actually trading, I found a bigger, or how can I say it, percentage wins, success rate, strike rate, very, very high. Okay, because when I was actually starting out, I used to do analysis for days. I used to sit there, draw lines, have fibs and all of that stuff. So, I mean, with using this method as well, I actually got stuck in there. I was looking at everything, looking at TDI, if it's there, the perfect, like the perfect entry does not and will never, ever, ever exist. It's not there, right? So you need to just deal with it in the simplest way possible. And hopefully, what we will be doing tomorrow evening will just clear up everything and just give you a good idea of what the technical side should be. Okay, so like I said today, with my session this week, I didn't start with the technical side of things. I wanted to come in last and just order things out in terms of importance. Okay, so now hopefully we all do remember the number one rule from yesterday. Number one rule in trading is not to lose money. Because if you're losing money, if you lost money and you're out of the game, obviously you can't gain experience. The only way for you to gain experience in trading is for you to stay in the game. So the longer you stay in the game, the more you're actually going to learn and the better you become at trading. Okay, so if you have $100 account, for instance, let's say you find a quick micro account, $100, and you take, let's say 0.1, which is a mini contract, and 50 pip stop loss. Boom, they hit the stop. That's 50% of your account gone. And next trade, same thing happens. That's your account gone in 2 trades. Now you didn't learn much in 2 trades, but if you risking 1% per trade, and for some bizarre reason you lose 100 trades in a row. I mean, 100 trades on a live account, that's a very substantial amount of experience, but obviously the chances of that actually happening are very slim, unless you're very, very, very good at actually losing. Okay, so let's not worry about too much about the entries. TDI is the moving averages today. We're going to do that all tomorrow. Today we're just going to focus on keeping things simple. Okay, now, like I said yesterday, the more you trade, the more wealthier you make your broker. Right? Your broker does not and will not tell you that you're over trading. So the first thing you need to note is that the broker will actually turn your account down. Like I told you guys with the example from yesterday, guy $100 account, 25 trades a day. That would be anything between $13 to $15. Now, an amazing stat that I actually found as well is that about 50% of traders' accounts after a year are cumulative. 50% goes towards the broker. Okay, so you can see how much the brokers actually do make of people trading. That's why I always say minimize your trading and just maximize on your lot sizes and just keep increasing your lot sizes, your leverage, and just to basically minimize you having to go in and out of the market, having the broker turn your account, because you have slippage, you have your spread, some have commissions, you might have swaps. All these charges go into your account, and if you are proper like business manager, as you should be with this, if you're trading, you need to look at the bottom line each and every day. You need to look, okay, how much did I actually spend on trading? So not just your data and stuff like that, but I mean the commissions, I mean the swaps, I mean everything that the broker charges on top of your account. You need to actually have a look at. Okay, hope you guys can hear me now. How's the sound now? Hello guys, can you hear me? Is the sound okay? Okay, the thing is I'm just doing it through my laptop today. I don't have my headphones with me. Okay, so it's all good now. All right, no, perfect then. So as I was saying, the broker wants you to trade more. So the more you trade, the more excited he gets because he is making money off your trade. I'm sorry guys, can you hear me? Just forgot to charge it. Okay, perfect. Now in the market is always smart money and dumb money. And now both actually want money. Right. So both smart money as well as dumb money actually want the cash that's up for grabs, so to speak. So obviously it won't be as easy as some people think it is to actually take money from smart money because you need to be smart money. You need to understand what smart money is and what they do in order for you to actually fall under the category of smart money. Right. So with the concepts taught by Menzi now, you can actually have a clear understanding of what smart money is and how they work. And then of course try and trade in line with them. Okay. Now some things will actually factor in as well. But in essence, I mean, it should be easily readable on a chart. Okay, especially when in hindsight. Okay, because in hindsight you can see everything. The only thing is that when you need to actually take a decision, pull the trigger, not move your stop, not move your TP, that's when the things start to become a bit fuzzy for guys. All right. So let's hop on over to our next slide. Okay, so now I'm going to talk about a lot of the common areas that traders in general, and I'm sure some of you guys might also be familiar with some of the stuff that I'm going to talk about now. Now, firstly, we have this scenario. Okay, let's say you take a trade, consolidation, stop hand low, and W formation, you buy. Okay, market just rises, gives you 5-10 pips, and moves against you, right? And then it consolidates again. So you already have a buy. Let's say you had a stop loss here, and all of a sudden you just take your stop loss out, remove it completely, or you just shift it down. You just keep on pushing it down and keep on pushing it down. And in the process, the market doesn't usually move like this, right? Because I'm sure you guys know, market doesn't do that. It has a bit of, it has some pullbacks, it has some consolidations, and then another drop. Now, this is a still contract accumulation side of things. So the market is actually accumulating contracts on either both sides. Okay. So let's say this is the first push, this is second push, this is third push. Okay. I'm sure Men's might have done that with you guys, but if not, there is a video on the website. You can check that out, or you can just wait for next week's session. But with these contract accumulation phases, this might induce people to actually take a trade in the wrong direction. Okay, as funny as it might sound, scaling in the wrong direction is something that's very common, and I'm sure it has happened to every single one of us. So over here, you see this as that W formation, you buy, and market drops down, you move your stop loss, and again, you see this, okay, no, he's definitely going to rise up now, so I'm going to add this buy over here at this level, and then once it gets here, I'm going to close this buy that's on the minus. Then he just moves away again, drops back down, and consolidates again. You're like, okay, now he's definitely going down. You might be on a nice support level from the previous day or the previous week. And based on that, you start justifying your entry into scaling in the wrong way. So adding to a losing trade, for me, is one of the worst ways to actually drain your equity. And if you have a losing trade already, there's no need for you to actually add another position, no matter how confident you may feel that it is going to go back up, right? So that should be clear from the word go. The only time you actually scale into a trade is if your trade is in profit. That's it, no other reason, right? So now, just adding into a losing position, the one way that you can combat that, for me, I would suggest, is sticking to a rule or a set of rules that dictate how many trades you can take on a currency pair. Okay, so if you do take a position like this, let's say on a W, going long, and market shifts away from you, for whatever reason, let's say the stop loss decided to remove itself, okay, and the market moves against you. Now, for me, what I used to do, which does take quite a bit of practice, was to hedge the position out and just let it drop, bottom out, and then take the profits on the shorts, and then just wait for it to come back up again. But you need to be cognizant of the position size and when you actually do that. But in this example, what you should do is have stringent rules on how many trades you take per currency pair. There's no need for you to add onto a position. If your trade is on minus, you should not be adding onto it. So that's one thing that you can actually have written down within your personal trading plan, and something that you know that you definitely need to follow on a day-to-day basis. Okay. So secondly, one of the most common errors that I do see is people actually looking for a consistent dollar amount on a daily basis. Now, as motivating as it might be, if you say you want to make $100 each and every day, okay, now that would suggest that you actually do control what the market does. Okay, no one controls what the market does except those guys, right? So the big guys actually know where the market is going. They know if it's going to move. They know if the currency pairs that you are going to be trading are going to have significant movements. Because at the end of the day, you're going to suffer one or two losing days. Okay, now that is not a problem. Every single trader, and I mean every single trader, goes through a loss, goes through a losing day, or I wouldn't say losing week, but I mean a losing day is quite alright. Because if you try to get back in, you're trading under the emotion, and you try to get what you lost back. Now that can be a constant fight between you and the market, and obviously the market will always win. Okay, the market always wins if you go in with the tug of war sort of mentality, right? So looking for a consistent amount daily in terms of dollars. Let's say you just want $1,000 a day. Okay, that's fine. Great, it's a good motivator. But at the end of the day, realistically speaking, you're gonna have some days where you're not gonna come close to $1,000. You might go on $600. You might go on one day, perhaps during NFPs. Let's say you trade NFPs or F1s, so you might make $2,000 on that particular day. So days aren't the same. The best thing that I would suggest is look for a pip amount. Okay, so look for a minimum pip amount that you look for in an entire week. So rather than saying, okay, each and every day I need to make 100 pips, just say, okay, on a weekly basis, I need to have at least 500 pips. Now, you don't put too much pressure on yourself on a day-to-day basis, because let's say you go in, lose one trade, 50 pips gone, already that has put you under an immense amount of pressure. So now instead of you making 100 pips, you need to make 150 pips. But you know, if it's on a Monday, you can still make that perhaps on Tuesday if you don't see any real opportunity. So spacing it out in terms of a week, instead of saying daily, will actually relieve a lot of stress. So you're not forced to trade when you don't see setups on that particular day. Today, I didn't see anything. Well, the ones we did analyze in the morning, the Aussie dollar and the GBP USD, I wasn't in front of my screen when the GU actually set up, so I missed that. I was just trading binary options for almost the whole day because most of the market was just consolidating and they really weren't behaving. So I didn't bother myself there because I know tomorrow they're probably going to set up, probably going to have really decent setup. So if I didn't make my target of 100 pips today, probably going to make 200 pips, 300 pips tomorrow. You understand? So spacing out in terms of pips on a weekly basis and not on a daily basis will actually alleviate a lot of stress. Okay. Now, there's also the issue of trading with money that you have an emotional attachment to. That simply means if you need to pay rent, you have $500 you invested, you need to pay rent, you need to make a profit of another $500 before the end of the month. Okay, now you have already two things that are actually missing, are wrong in it. You're trading to actually withdraw, firstly, which I don't suggest. I'd like to see you compound. And then secondly, you have money that has some sort of emotional baggage attached to it. So if you're trading under that sort of pressure, I mean, some people have said it's good pressure. For me, it did work. It did work for some time, but I remember one month where it didn't actually quite work out well. So for me, rather just don't trade with the money that you have an emotional attachment to, that you need to make this amount of money, because it's really going to cloud your judgment in terms of trades. You're going to start seeing things that really aren't there, and you're going to start taking trades that have very low probability. Okay. Now, I like to call this analysis paralysis, which is basically what I spoke about a bit earlier on. You not being able to decipher what the chart is actually showing you. Okay. Everything you need to know is right in front of you, and trying to look at too many factors when you're trading will actually confuse you so much, and you won't be able to take a decision whether to buy or sell, whether to sit on the sidelines, whether it's a good trade or a bad trade. So what I usually do, I focus more on the success ratio, to be honest. Okay, so I focus on the success ratio, saying, okay, now I want to have 10 trades this week. Out of those 10 trades, I want 9 to be profitable, or I want 9 to be gain this amount of pips, but instantly when you actually start talking like that, like you need to have at least 80 or 90% success rate. You start becoming picky with your trades. You don't just throw anything there, because it will affect your success percentage at the end of the week. So the fear of actually, or the clouding of your judgment when it comes to over analyzing the market is something that's very real. So what I usually do is just have a quick check up or check down. I did upload the check down that I use. It's from a while back. It's a bit extensive, but it's a spreadsheet, so it's like it has drop down, it did drop down. So you just pick your trend direction, your levels. So it's quite simple. But now I just do it off head. Okay. So you can go in there, you can download it, and you can try it out and see how it works for you. And you can just adjust perhaps the things that you do need or things that you don't need, and you can just take those out as well. Okay, now the one huge problem that I do notice as well is over leveraging. Now, if you over leverage your account, that simply means that you are trading with an amount that is over your pre-defined risk percentage. So if you say you have $1,000 account, okay, let's just use $100. You have $100 account and 2% risk, right, is $2. Now, if you over leverage your account, you are basically, let's say, trading on 10% risk, you're trading on 15% risk, 30% risk. So simply meaning that if you do lose this particular trade, you will lose 30% of your account. Okay, so that's basically over leveraging your account. You can, obviously the lot size as well will play a role into leveraging it, but I mean, for sometimes if you might remove your stop loss for whatever reason, because I have heard people saying that stop loss, I think the broker removed the stop loss or something like that. I won't say anything, but I've heard people actually telling me that the broker removed their stop loss and they didn't actually do it. So with that, I mean, you don't have a predefined risk. Okay, so it's just basically you against the market. If it goes against you, you can take your whole account if you don't have a stop loss. So that would also fall in under over leveraging the account. And then we have our FOMO, fear of missing out, resulting in what we call foot soldiers. So, I mean, with the whole foot soldier thing, it's really just you taking a trade that you're not really confident about. Because if you have $10,000 in your account and you take and you see the Aussie dollar, US dollar trying to setting up a nice W formation, for instance, and then you want to go long, but since you're not quite certain, you're not going to use your mandatory, let's say, half a standard on the account or one standard or for that particular trade. What you are going to use, you're going to use a 0.02 or something. So that's basically what a foot soldier is, something that is way below your risk percentage, because you say you're risking maximum 2% or 1% per trade, and a foot soldier will probably be like a 0.002% of your account. Okay, it's not anything significant. It's just that you want to be in the market when it moves, even if you make $5 off the move with a $10,000 account. So that's basically what a foot soldier is, and for me, that is how I basically look at it as well. Okay. Now, the fear of losing money. Obviously, no one likes losing money. We're all in the business. We're all here to actually make money. So losing it is not an option. Now, that can be a positive thing, also can be a negative thing, because in trading, you are going to lose some trades, right? That is a guarantee. No trader, no matter who they are or how much money they control, no retail trader will actually evade the whole process of losing money. Okay, so just get that in your mind, all right? Get that, let that resonate with you, that losing money is actually part of the gaining process. So you can't actually win in Forex without losing money at some stage. So having it predefined or a set amount that you're willing to lose, that is not above your dollar threshold. Because I remember I had a dollar threshold of $100, which simply means I could not risk more than $100, no matter how big my account grew. $100. If I went over $100 loss, I'd actually become a bit depressed for some reason. It wasn't a huge dent or anything in the account. It was just the $100. Something psychologically in my mind was like, losing more than $100 is a bit too much for me. So obviously you need to work around all of those. Everyone has that amount, that set amount in their mind, and trying not to actually go above it and just easing it through is the best way for you to actually get over that fear or that threshold as your account grows. Because immediately if you take, let's say in my example, when I took more than $100 loss, I'd actually just jump in immediately, try to get that money back. Okay, so that also is something that can factor into your trading. And I know people who trade because they're bored. Okay, I know people who do that as a hobby. Already discussed it, won't go too much into it. And also a factor of over trading. Like I said, doesn't make you rich. Over trading doesn't make you rich. It makes the brokers rich. It makes them happy. That's why there's so many brokerage firms. I mean, with brokerage firms, that's why they have the tallest buildings. They sponsor these soccer teams because they churn people's accounts all day long. That's what they basically do. And so the most important thing that you need to do is to limit your trading costs, and just try to maximize in terms of leveraging of either your leverage or your lot size increase. Okay. Now, also removing stops. Let's say you had a 20 pip stop loss and you remove that stop loss, market shifts against you 200 pips. All of a sudden, now you've changed into a position trader. You were a spot trader or a scalper. All of a sudden, you're now a position trader. So you need to wait for that trade to come back. Let's say it might take a week, it might take 3 weeks, it might take 2 months. I won't mention any names, but it might take 2 months for the currency to actually come back to your position, to your entry position. Now, obviously, if it takes you 2 months, you are definitely a position trader. You're not even a swing trader, you're a position trader. So that can really just play with your mental wherewithal. Okay, so just a quick one regarding books. I know someone actually asked me some time back. I think it was last week about any recommendations in terms of books. I mean, I've I have audio tapes, I have books, and all of that stuff. I invested a lot in terms of the mental side, the psychological side. You can see over here, this is a book by Dr. Alexander Elder. And this one, I mean, it's free. You can get it on YouTube. That's why I decided to put this one up, but I'll send an email or just put on WhatsApp the rest of the book collection. So less than 1 minute left. I'll send the second code for the second session. We'll go over and we'll look at some charts. I want you guys to see how I use the scripts, what a backup order is, and take questions after that. So, okay.